Welcome to the Impact ECMO podcast. We highlight the stories of impact innovators and connect them with the allies they need to amplify the good they can do in the world. I'm your host, Jacob Haney. The Sustainable Development Goals have a $4 trillion per year investment gap in developing countries. Institutional investors could potentially fill that gap, but they cannot find suitable opportunities at the right scale. Chris Kuchanny with Impactable Group just might have a viable solution. So tell me about your journey that led you to this point.
Well, I started my early career in the city. I started on a derivatives prop trading desk, which means I was trading the bank's own capital. And it was all very much finance, make money. And I think there were a couple of things in the background that made me really kind of question what I wanted to do with my life. And I put them as, the two things of farm and faith. Family, actually, just as I was starting university, went to Africa and they bought a working farm and a visitor centre. They set up charities, they built a school specifically for orphans. And they were really inspired by trying to help people in very poor community in the northern part of Zambia. So having gone out to visit them many times, having been part of that journey, that was really, if you like, the start of a journey for me on understanding what's going on in emerging markets and really having my heart pulled by the struggle that is poverty. And I guess also on that early phase of my career, after having made and managed quite a lot of money for quite a young age, I actually realized that there's only so much satisfaction that can come from that. And I actually had a moment of faith where, as I stepped into my Christian faith, I realized that I wanted more from life. It wasn't just about making money and lining pockets. So that led me to launch a new hedge fund, actually. And the hedge fund had an interesting structure. So we started it with, from the word go, a charitable structure, so that whilst we had a sort of global fund on one side that ended up growing, it was over $500 million in the main fund. It had a multi-billion-dollar portfolio, a couple of funds. And then the fee income from that, or at least up to a quarter of the fee income, went into a philanthropic pot, if you like, a foundation. And that foundation started on a journey of working out how we can help people in emerging markets through development, initially actually helping to fund, for example, infrastructure like schools. But then going on a journey of, we need to support business and helping people on with microfinance and then with SME finance and then with full value chain investing, really trying to develop economies, recognizing that as they grow can really help with that issue of poverty. And I think on that journey, one of the things we realized is, going back to your initial statement and that question, is that $4+ trillion a year funding gap, to meet the SDGs, is simply unattainable through philanthropy. It's actually unattainable through overseas development aid as well. Not because the money isn't out there, but the probability of that scale of money coming into philanthropy just simply is improbable. So we really need institutional investor money, which is where most of the world's capital resides, in pension funds and asset managers and insurance firms. We need that to come off the sidelines and have investable opportunity into emerging markets, and in that way scale and start to narrow that SDG funding gap. So that's entirely what Impactable is all about.
What tends to be the biggest misconceptions that you find about emerging markets and sort of maybe the perceived risk versus the actual risk, or some of those hurdles that particularly institutional investors might face that you try to help dispel?
Yeah, I think the first thing I'll say is, of course, there is risk in emerging markets. And when we look at emerging markets within our universe, we've got 77 approved countries for trading, and there's another 30 or more or maybe more than that actually, that are not approved for trading. We're talking over 100 nations, and the diversity within that nation block is vast. So, of course, there can be lots going on in all of those nations at different times. But I think because of that complexity, because of often ignorance, actually, just a lack of understanding, a lack of experience, then the natural perception is it's just too risky. I'm not gonna go near it. And there's a number of problems with that way of thinking. If I go back to the risk, and I'll come back to the way of thinking in a moment, how it impacts people in developed markets, and particularly developed market portfolios, is that risk can be mitigated. Now, one of the key ways of mitigating risk is through diversification, of course. So you can diversify away a lot of the risk by having a broad remit, which is what we're coming in doing, a broad remit by country, a broad remit by sector, by having maximum position sizes that are relatively low. But also you can look at the different types of investments, and we've looked across the board: public, private equity, private debt. We're launching with a private debt strategy. Why are we launching with private debt? Because emerging market private debt, the largest database out there of emerging market private debt performance, is called the GEMS database. It's all the MDBs and DFIs pulled 70,000 data points over 20 plus years together. And the loss given defaults, the actual loss on that portfolio was an average of 1% a year. Now, to put that into flavor, most people would expect, I've asked people and I've had answers ranging from 20% to 60% of expected loss on that type of portfolio. So to come in at a number that's actually 1 is genuinely shocking for people. And how is that possible? And I'll explain in a second how it's possible. But to give you a comparative, that's lower loss given defaults than senior secured debt investment, the highest grade corporate debt investment in the US and Europe, equivalent and slightly lower. So, you can achieve that level of low loss rates if you're very rigorous, if you structure deals well, if you have security, you have the right covenants behind your transactions. There's a lot that you can do in practice that can de-risk alongside, of course, diversification and a whole range of other factors. So we've spent the last couple of years really working through this, fighting to work out what's the best way of executing. And then we're also executing in conjunction with some of the leading emerging market private debt investors. So what we're doing is co-investing alongside those investors, which means that effectively we're piggybacking off their expertise and research, often their local market presence and knowledge. And then we're adding our own due diligence, our own impact processes, which are very rigorous on top. And in that way, investors in what we're doing are getting sort of top level due diligence and the market leaders level due diligence with even higher due diligence on top. So I think if you're very vigorous, if you're intense about it, you really care, and actually you do need to have a collaborative, supportive relationship with the companies in which you're providing, in this case, debt, or in other cases, it might be equity, then you can actually produce a very high quality and low risk return.
I mean, I'm curious though, how do you have a solution that others haven't been able to crack this code?
Well, I think it's taken a while. It didn't just sort of instantly come about. And the way that we've done it is we've designed something from the start that is available to and investable by institutional investors. So from the beginning, it's been very hard-nosed. And we need at least 4 factors to be able to be attractive for those investors. The first one is it's got to be financially viable. And institutional investors would generally expect a higher return for an emerging market investment than they're getting commensurate investments in developed markets. So we're coming out with a product that's aiming at double-digit net returns. How can we do that? I'll talk about in a second. I'll talk about these 4 first. So 1 is returns, 2 is risk. We've already talked about that low risk element. We've simulated return profiles, and 1, you've got that kind of 1% loss given default rates across large data sets. When you combine that into a smaller portfolio, we think we can still get to sort of within 2.5%, 3% maximum drawdowns by being very careful about what we invest in and being careful around our portfolio construction. We've built everything we're doing for scale. So something like 60% of the emerging market impact funds or more, at least 60% are under $100 million. And a small fraction, well under 10%, are over $1 billion. What that means is most of the market is institutionally uninvestable. A lot of these big instos have minimum tickets of 50, 100 million. Right, so and they don't want to be more than 20% of your fund. So most of the industry structure themselves in a way that they end up being in this kind of circular discussion whereby they can't scale because they can't scale. And we've designed something that from the beginning is built to scale. So everything that we launch will have multi-billion-dollar capacity. And then everything we're doing is also built around impact. We've got very thorough impact processes which have been vetted by Impact Institute and given a big thumbs up. Everything we're doing is really designed around trying to help with this transition that's ongoing. And the transition we're seeing is the largest industrialization in human history. It's so big that it's at least 13 times as big as the previous largest industrialization in human history. And what's interesting about that is all of that industrialization substantially is happening in emerging markets. These are markets where the vast majority of planet Earth lives, well over 80%. Markets where most of the growth in population and real GDP growth is happening. We're seeing the next 2 billion growth in global population, more than 2 billion will be born in emerging markets because we're shrinking in developed markets. And on an economic growth basis, the real GDP growth on average, year after year, so far this millennia has been 3.3% higher in emerging markets than it has in developed markets. So there is a very strong argument for most developed market portfolios being wildly underweight emerging markets. And we see the problem with that. We see the problem with that with recent events, with COVID, with 2008, with all these major market events. Because what happens? Well, the left tail risk, these unusual downside events, when they happen, everything correlates to one in developed markets, which means that everything moves in the same way. And actually, if you look at particularly the space that we're launching here with in private debt, that is not the case. You might see a small uptick in loss given defaults, in loss rates, for example, but it isn't sustained and it's not of the same scale as you'll see across developed markets. So we've built a strategy from the ground up that has been unwavering in we must deliver those four factors of very competitive returns, low managed risk, at scale, with significant impact, but it's got to be hard-nosed, financial first, quality of financial return first, and that's the thing that can enable the impact happening later. And how we do that, we could go on to talk about.
Yeah, I mean, it sounds like a winning combination. I guess what has been the biggest hurdle, though, in terms of getting this going? And maybe leading up to that, like, where are you at in that journey? Is this just an idea in your head, or is this, you're on Fund 5 and this is a vetted thing? Where on that journey are you?
Well, somewhere between the two. Sadly, we're not at Fund 5 yet, but yeah, God willing. But we're certainly well beyond it being an idea in our head. We've developed a portfolio of opportunities here that demonstrates that we can do this at scale. And we've got knocking on 300 different opportunities that have come in, both through our own origination and through our co-investment network. We're scaling through co-investment, as I mentioned or touched on before, which means, with those leading emerging market private debt players, we've been going around the market and asking who's got spare capacity. A lot do, because their diversification means they can only invest a certain amount in each trade, in each deal. So we'll come alongside, we'll take up spare capacity where it meets our criteria. So we've demonstrated that we've got a scalable portfolio of opportunities that thoroughly due diligencing both impact and investment perspective. We're speaking with a range of LPs or investors across different jurisdictions, and we've structured what I believe to be certainly a very innovative structuring that offers multiple ways in for investors. We've got a more liquid version, open-ended. We've got a closed-end, highest return, 5-year lock version. And then we've got a principal protected version that completely de-risks the investment with no capital at risk or limited capital at risk, depending on optionality there, for investors who aren't quite sure about emerging markets but want to dip their toe. So I think, that latter thing is going to be very important, because there are a number of investors who are saying, look, we agree with you. We know we're underweight emerging markets. We can see the opportunity. We can see the diversification advantages. We can see the average return, quality of return advantages, but we just don't know where to start. So we're trying to provide a product that allows them to do that, as well as provide products for other parties who are maybe more familiar with taking that risk and keen to do so either on shorter term or longer term basis. So we're coming to market this year. We're hoping for that to be late Q3. It may slip a little bit depending on LPs. We've got a number of larger LPs who are circling and very interested, and we'll see where we go on that journey.
We crossed paths, I think originally it might have been the GIN in Copenhagen or maybe the Impact Summit Europe. I mean, we tend to orbit in some similar circles. And at those events, though, there's also, the large impact asset managers that often tout a lot about they have the boots on the ground and they have the offices in emerging markets, which you aren't coming in saying you have that infrastructure. Do they see you as a potential threat, or are you a partner for them, or how does that work in that ecosystem?
Yeah, so we're building an ecosystem where we very much are building up a partnership with those asset managers. And as I touched on before, one of the issues is that a lot of these asset managers are going out and they're doing 1 or 2 years or more of due diligence to get ready to make an investment, to get ready to provide, in this case, debt capital for some of these investees, these companies that are growing. And when they get to that point, they realize, well, we've only got, they know on the journey, $10 or $15 million, maybe maximum for some of the largest guys out there to invest. And often these companies need a lot more capital. To give you an idea of the scale, I mean, Africa alone, the SME section, the mid-market in Africa has a $2.5 trillion funding gap. It's a massive market. And so what we're doing is we're building a network where in the early phases here, we're principally coming in as an additional investor that invests alongside. And depending on how that, that can be structured in different ways. It can be sort of caveat emptor and, we're just taking up some excess capacity, or it can be maybe a full service that they provide whereby we pay for that service and we're getting access to their monitoring, reporting, due diligence. In either way, we're coming alongside, we're adding due diligence, we're adding alpha in the form of helping support them in this investment. We're also adding capital. And then as we grow, we're doing our own due diligence on opportunities that we're sourcing, we're originating, and that group of opportunities is growing. Where we're in the same position and they're too large for us, then we'll look to offer that back to our network as well. So I think it's in these markets, it's really important for people to realize, and maybe I think the private debt market has been much better at this than private equity in my experience, where they're a little bit more kind of closed off. Private debt I found refreshingly open, where people realize that, look, we're running tail risk here in private debt. You're paid in emerging markets, you're being paid more than you would maybe in developed markets, but you're still being paid modest amounts, not multiples of your invested capital. And so the real important thing is you get the tail risk right, i.e. you don't get the core credit risk wrong. And to some degree, more players in the room is an advantage. So I think across emerging markets, my belief also in equity land, it's going to be far better for everybody when these networks expand and people are better at sharing their toys, because as we work together shoulder to shoulder in these markets, we can make things happen bigger, better, and everyone can benefit.
Yeah, I would second that, just general philosophy. I mean, as we work with different impact organizations and helping them scale through better storytelling and reaching who they're trying to speak to, one of the soapboxes I keep finding myself on is that we need more cross-pollination. We need more of that connective tissue in the industry. And if we're all trying to hold our cards so tightly to the vest and save the world on our own private island, we're not going to get there. We need each other really, and we're going to get further faster by working together. And so I applaud any efforts that are trying to stitch together more of that, cooperation. And in that vein, what are the allies that you need most right now?
There's a couple of things in terms of the hurdles we're facing and some of the allies that we would all benefit from. I think one of the things is, as you're launching a new product, and I think our product is very new, it's very differentiated, there is sort of this educational aspect of it. You're trying to educate investors, particularly institutional investors in developed markets who haven't had much exposure to these areas, on why this is so important for them. So we're actually in the process of finalizing a YEM private debt paper, and that is really aimed at kind of trying to provide some actual market data, independently sourced, so people can actually begin that journey in many cases, or advance that journey of why invest in these markets and how to do so. As part of that, we have a number of partnerships that we're building there, and as that piece comes out, I suspect that we're going to be doing that in partnership with a number of major entities. So anyone who wants to join on that particular piece and getting the YEM, particularly YEM private debt story out there, we'd be very willing and eager to partner with. The other two things is, one, I mentioned our co-investor network a number of times. We currently have well over 100 names on our long list and several dozen who are already providing us with investment opportunities, and many of those we will be doing the same on ourselves, i.e. quid pro quo, providing opportunities back, but always interested in others. So if you're a professional investor in emerging market private debt, if you've got boots on the ground, you've got the skills, you've got a track history, then let's speak and let's find ways that we can work together to really scale up this part of the industry, and then from there other parts. And then the other thing is, of course, LPs. We need investors, and we need investors who are willing to engage, because what we're doing is not simple. In one sense, okay, it's just emerging market private debt, it's just private debt investment, but because it's a new product with a couple of new nuances, in one sense, I don't think almost anyone's done this before, if anyone at all, in terms of the way that we're structuring this. So we need LPs who are willing just to kind of take the time to get to understand this. I think when they do take that time to understand it, they'll realize that what we've developed here is something that meets those 4 quadrants of the expectations that they have for this type of product in a way that should meet their needs. And I think a lot of them, and actually we found this so far, those we have been speaking to, generally very few have said that this doesn't make any sense, and they, for understandable reasons, they don't have any space in their portfolio, or they can't invest in space right now, they're kind of limited, has been typically the responses, as opposed to we completely don't get it. So if there are LPs We do have one small slither, which is a concessionary slither. So if you've got philanthropic capital, we've got a product that can at least 10 times multiply your impact in scaling emerging market impact investment. And actually, we've got a line of sight for that being, it could be 100 times. So back in the day when I was managing our philanthropic pot, which I still am, it's just a bit smaller than it was because we've spent and invested a lot of it. But when I was, then something like that would have been really exciting for me because, the scaling of the capital in that market would be interesting. Aside from that, what we're mostly looking for is investors who just wanted to be in on any one of those three products I mentioned, open-ended, closed-ended, or a principal protected product.
And what does an ideal LP for you look like?
Well, I think, as it says, one who's willing to actually do the work on the way in to understand what we're doing. They're willing to be on that journey. I'm not saying, a lot of the LPs we're speaking to do understand these markets. I'm not saying everyone doesn't, but it's a party who's willing to engage with emerging markets, willing to understand the actual risks, willing to understand how that fits within their portfolio. And I think, again, what we've structured is there's an opportunity for most here. We're principally looking at the institutional end of the market. So the ideal is, right at this immediate moment, someone who could come in as an anchor with a 50 million plus ticket. For some people on this call, that sounds like an enormous ask. For others, that's their day to day. But, that's where we're at. And we do have a number of parties who fit that bill who are looking. And for those, obviously, who would come in as and when we get to the point of launching a product in the earlier phases, then there would be, of course, advantages to them to do so. So in the first phase here, we're just like, the analogy I use is, it's like filling a jar with marbles. You want to get the big marbles in first and then the smaller ones fill in around it. And so we're looking for a couple of those larger guys, but we're also looking for other investors who are interested, of whatever guise or whatever form. And, and then the other tranche was that kind of sort of quasi-concessional pool. So we've got about a 30 million maximum. We've already got soft circled 5 to 10. So we need another 20 odd in that pool. That would catalyze, I think, potentially a market first product in terms of a de-risked, hopefully credit rated, principal protected product that would, I think, be scalable and be a bit of a game changer actually for investors. So if any of that is interesting to any of the parties listening, particularly any of the LPs, then please do get in touch.
And they can be anywhere in the world, or it's EU, UK only, North America, doesn't matter?
Yeah, we need to be very careful in terms of how we market and where we're at the moment. So there are certain markets, we're in pre-marketing phase in various markets in Europe. And, we're in pre-marketing phase for other jurisdictions around the world as well. So in theory, we're aiming to launch a global product that is investable. We're planning for a product to be out of Luxembourg. We haven't launched a product yet. And so we're in that sort of careful liminal space to making sure that we're polling investor interest without definitively confirming exactly how the terms and everything will work. But we're getting closer to pressing buttons on launching the entity. And as I say, I think we should be in a position to do so late third quarter or onwards this year.
If someone is interested in learning more, where would you point them?
Well, our global head of distribution, Raj Gohil, would love to hear from you. His number is 07. No, I'm just checking. Do hit him up on LinkedIn or wherever. We have a pretty up-to-date website, actually. So our website, impactablegroup.com, is a lot of information there. Or just reach out direct to Raj or myself or any of the team, and we'd happily engage further and to see how we can help.
Any last words before we let you go?
One of the things I would say is that living in developed markets as we do, I've focused this conversation entirely on a product that is focused on financial first impact investing. And from the gaze of this part of the world across the rest of the world, it's hard to understand the scale of the issues and how those issues can affect all of us. As I mentioned, we're seeing the largest industrialization in human history. We currently have 5 billion people living on less than $10 a day. Now, those numbers may not mean very much to a lot of the people listening to this until you've sat down with someone who is in that position, who is living hand to mouth, who genuinely is concerned about putting food on the table, let alone being able to provide for the medical needs, the educational needs, long-term job prospects, and the other aspects of what most of us would call minimum viable living. It's heart-wrenching when you go and visit and you see people in this position, and also inspiring when you see people acting with such grace in these horrifically challenging circumstances. So we're currently talking about what, at least 60 to 70% of planet Earth living in that level of condition and worse. And my table thumping belief is that that doesn't need to happen. And that's because of this, a couple of things. One is we have the capital, we have the technological resource, we have the ability. And this is not just an impact consideration. It's also, something that's sort of arm's length and unaffected for us in developed markets. When I mentioned another 2 billion people are going to be born, or more than that, into emerging markets over coming decades, we're going to see, for example, 1 billion people born in Africa. Now, what happens when that billion people is born in that continent and the continent's warming, it's less and less livable, and there are no viable jobs? If we don't have a green and financially inclusive transition, it will impact all of us. What happens when 100 million people decide they want to cross borders into Europe? There's nothing any of us can do. And the other factor here is that answering that problem is not only deliverable, but actually it can be delivered in a way that benefits everybody. That sounds almost too good to be true, but it isn't. And it simply isn't, because impact investing doesn't even have to be, you don't have to consider the impact to consider the financial viability of increasing developed market portfolio exposures to emerging markets. As we do that, as we provide this capital, we fill these funding gaps, we'll make stronger returns, we will improve the quality of return in our portfolio, and we will help solve these global problems, which ultimately will, in most of our lifetimes, impact all of us if they aren't answered. So the encouragement, I think, for everybody is just to take the blinkers off, have a little look at what is actually out there in emerging markets, and try and find a way in that fits your risk category in some aspect of your portfolio. Because whatever that is, whether you're super high risk, super low risk, or anything in between, there is an opportunity out there for you to do so if you choose to invest a bit of time in finding out.
I applaud what you're doing and excited to see how this all develops, and excited to see your launch and to shift more capital to where it needs to go in these developing markets, and to make a more just and equitable and sustainable world for all of us. So thank you, Chris.
Yeah, thank you, Jacob. Appreciate you taking the time.